Welcome back to the Wealth Eazy Show, where we talk all things wealth, health, and real estate. Today's going to be a lot of fun. I've got a brother from a different mother as my guest today. We are both very passionate about helping people and educating people about money. My friend, Chris Kirkpatrick. Chris, welcome to the show.
Hey, man, what's happening? Good to be here.
Oh, man, I was looking forward to this.
Me too.
This is awesome. I watch a lot of your YouTube videos, and we both share the same excitement and the same passion for helping people and getting them off that Dave Ramsey train. So,
amen to that.
Yeah, I know that I'm out there very active on social media, and so are you. And I'm constantly trying to educate people on the truth about money and how to create their rich life. Mm-hmm. What do you do? How do you go about approaching and educating people about money and financial literacy?
Ooh, that's a good question. So my philosophy, and this is something that I've just kind of grown into over time, is nobody likes to be told their baby's ugly, right? And so like, I guess what I've realized, I used to come at this when I first got into the business, and I think everybody who learns what we know, we go through phases, right? Like when you first realize it, there's this like, wait, there's no way that could be right. Because if it were true, everybody would be doing it. And then you realize it's right. And so you get this like excitement that you feel like this passion that you want to go. And it's just like, you're a hammer and everything you see is a nail. And you're just like trying to hammer, like you need to know this stuff and do it differently and all that, like, and you're just trying to like help people, but at the same time, it's not effective. And so what I've just realized is that there's no good or bad, right? Like I used to think Dave Ramsey was horrible, horrible, horrible. I still think he's horrible, horrible. Just the last horrible can hold off, right? But
yes.
But where he can work is if you just have no understanding of money and you just need like the basic rudimentary understanding of a budget and you have no self-discipline, Dave Ramsey could be good for you. Like if you have no self-discipline and you have no big aspirations in life, Dave Ramsey could work for you. That's my statement. That's like what I
yes.
if you feel like you have more out of life that you want to accomplish, that you want to contribute, that you want to pay forward and like all these different things, then Dave Ramsey is going to hold you back. That's the idea. My philosophy as a whole now is that not that it's good or bad, but that if you want to be successful with your money, you need to align your money with your values and your beliefs. That's everything.
100%, brother.
You have to align your money with your values and beliefs. And the reason people fail with their money is because their money is not in alignment with their values and beliefs. And I'm sure you're the same way. Talk to people every single day, 5 to 10 people a day, that that is the first thing I do with them is sit and I ask them questions about what do you believe? What do you believe about the government? What do you believe about taxes? What do you believe about inflation? What do you believe? All these things. And they'll tell me something and I go, where's your money saved? Where are you investing for retirement? Where are you doing all these things?
Mutual
and they tell
funds.
Me qualified accounts where you're deferring taxes. And I'm like, you just told me that you are concerned about all these things, but that's what you're doing with your money. No wonder you're failing. Because here's the deal. The human brain only allows us to put 100% of effort into something that we believe with 100% certainty that we'll be successful with. You cannot override the power of the subconscious mind. There's a great book called The Ant and the Elephant by Vincent Pacenti, who was an Olympic downhill gold medalist, right? And in this book, he talks about a study that references that when we make a conscious decision, I don't care whether you're trying to lose weight, you're going on a diet, you're trying to be better with your money and budget and all these things, when you make a conscious decision to do those things, your brain fires off at 4 million neurons a second. But the problem is our subconscious, which is really our internal programming and our why and like really how we just operate in default mode, right? That fires off at 4 billion neurons a second. So thinking that you're going to just control your money and white knuckle your way through it and be disciplined is the equivalent of an ant sitting on the head of an elephant thinking it has the ability to steer that elephant. It's delusional. It's never going to happen.
Such a good point. Such a good point. And you know what? Yeah, Dave Ramsey, he is really good. And for those of you listening in Canada and you don't know who Dave Ramsey is, he is a talk show radio host who gives financial advice. He is not a licensed financial advisor. but he is really good if you want to get out of debt. Yeah, he gives some great advice to getting you out of debt, but he gives fucking horrible advice when it comes to life insurance and it comes to investing in mutual funds. And yeah, we're going to get into that discussion later. You know, I get a lot of comments because I'm very active on my social media, and I get a lot of different comments saying whole life is a scam. What are some of the common misconceptions and myths that you would like to share to my listeners about life insurance?
Well, I would ask the first thing, if somebody says that, and I hear it every day, the first question I ask is like, why do you believe that? Right.
Yeah.
And
Give me
most
facts.
people, give
And they
me
never
facts.
can.
No, of course not. It's all emotionally driven. There's no factual basis behind anything. But the number one thing that I hear that I think is misunderstood is the fact that people say, well, whole life is a horrible investment. And my response to that is, you're right. It is a horrible investment.
It's not an investment.
It's not an investment at all.
Right.
And if you're looking at it as if whole life isn't an investment, well, then that tells me you don't understand it. So let's have a conversation about actually educating you about how whole life insurance works. And I don't believe there's any good or bad products in the world. I think every financial product has a role that it can play in somebody's life. The question is it good or bad for you? Is it in alignment with your values and beliefs, right? Like that's what it comes down to.
Your investor
and
DNA.
When people, right, in your investor DNA, exactly. And when you back that out and you start thinking about what is my investor DNA? What do I want to contribute to this world? What do I want to accomplish? And is my money being leveraged and utilized as a tool to help actualize those goals? And most people, the answer is no. And when you realize the value and the power and the leverage and the flexibility and the power of whole life insurance, and if you have an investor DNA of a contributor, of an entrepreneur, of a real estate investor, of that, then 99% of the time it's going to fall into line with it.
Well, you made a good point that there is really no good or bad product. It's
right.
Does it fit with your investor DNA, and does it fit within what is your belief? However, if you were to take all of the products out there, and I ask my clients this all the time, if you took every product out there and you wanted to perform in a certain way, you wanted to have guarantees and you want to have flexibility of contributions, is there any product out there that will give you maximum money supply and maximum amount of benefits in one product? There isn't. But I love hearing them come up with, real estate or a mutual fund or this or that. It's like, no, they're not going to give you maximum money supply and maximum benefits. However, there is only one product. If you only had this product, which is not even an investment, if you only had this one product as your portfolio, it is whole life insurance. That's why I think whole life insurance should be the heart of every financial plan.
100%. Yeah. I mean, I think that's hard to dispute when you really understand it. One of the things I teach, because I teach a lot of life insurance agents, and I'm really passionate about making sure that we're positioning life insurance as an asset properly, because it can be either misunderstood and the problem with it being misunderstood is people don't take action in their own best interest, right? And so my favorite part about teaching people is teaching people never to ask questions you don't know the answer to, right? Like so one of my favorite things in doing that is, and this is the thing, whole life is not an investment, right? So we'll agree to that, and we'll get that up, take that off the table, take that argument off the table. Well, what I do to people is I just turn it right back on them, and I say, well, let me ask you a question. Do you believe that every person should have an emergency fund? Right? And they go, well, of course, because, and remember, I don't want to ask questions I don't know the answer to, because any adult that is going to tell me, no, I don't believe then you're irresponsible. And you're going to tell me you're not good at adulting, right? Like that just like, and nobody wants to admit that, right? So everybody's going to say, yeah, I believe, like that is just the responsible thing. It's kind of like everybody knows you need to have an emergency fund. Okay, cool. So we can agree to, what do you believe you should have for an emergency fund? How many months of income do you think you should have? 6 months. That's like across the board. Sometimes people say 3 months, but pretty much 6 months. So I go, okay, where do you save that 6 months of an emergency fund? Where are you going to do it?
I'm going to put it in my bank account.
Bank account, right? And so my response to that is like, hey, if I could show you a place that you could like at a bare minimum, just build your financial foundation with a good emergency fund with safe, liquid, accessible capital that's going to outperform your bank account from a long term, that's going to provide ancillary benefits, and you look at all the things behind it, it becomes a big no-brainer. But we got to stop comparing whole life insurance to investments and start comparing it to the safe, liquid, accessible capital options that it is. And at the end of the day, whole life insurance is going to provide bond-like returns, muni bond-like tax treatment in the U.S. and in Canada as well. But like, I don't know if you have muni bonds up there, but
no,
muni bond-like tax treatment in the U.S. and money market-like liquidity.
Yeah.
Go find me another asset that could do that for you. It doesn't exist.
No volatility, bond-like returns. I'm in.
Yeah, totally.
And access to 100%. It without penalties.
Right. Yeah. I mean, it's just, I don't know. We're about the same age, I think. And yep. I don't know. Did you ever watch the NFL like in the 90s growing up, like watching like Sunday football or anything of that nature?
Yeah, in the 90s. Yeah, I mean, I'm a big Pittsburgh Steelers fan, and
okay.
And Sunday's we're playing each other.
Yeah. Oh yeah, we are.
It's gonna be
Look
good.
Steelers
and Cardinals is gonna be a good game.
You're gonna kick our ass. You're gonna kick our ass.
Well, we just fired our offensive coordinator, and for the first time in 58 games, we went for 400 yards.
Oh, I know. I saw that. That was awesome.
It was so good.
I was watching that game. But here's the deal: when I would watch football on Sundays, and there was this commercial that would always play. This one company, and they used to sponsor NASCAR. It was BASF. Have you ever heard of BASF?
Oh yeah, of course, yeah.
Right. So they would always say at BASF, we don't make your fishing line, we make it stronger. We don't make the paint you use, we make it brighter. And their tagline on all these different products was, at BASF, we don't make the products you buy, we make the products you buy better. And so whole life is not the investment you make, it makes the investments you make better. That's what it does.
I love
it. It's the BASF of the financial industry.
I love it. And that's why I say it doesn't matter what you're invested in, you need to have whole life insurance as the heart, the main character of your financial plan. Have a bunch of stuff around it.
Yep.
But have that as the main character. You can have a bunch of supporting actors, but you need to have that. Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Eazy Show. You know, a lot of people view life insurance only as a death benefit to provide for the family, but you and I both know, and this is what people don't understand, how they get to use life insurance as a living benefit. Talk to us about how someone can do that.
Well, I mean, outside of the access to the cash, that's one thing. I share a story a lot. I never used to focus on the living benefits, like the accelerated benefits of the death benefit of whole life insurance like I do now. Back on November 4th of 2020, my father-in-law was diagnosed with stage 4 pancreatic cancer. He twisted his ankle playing in a pickleball game and ended up in the ER. They did a scan on the ankle and they found out, no, you didn't actually twist your ankle. You actually have a blood clot. And then they scanned north and they found the blood clot went from his ankle to his groin. And upon scanning the groin, they found a 7.5 centimeter tumor on his pancreas that had spread already to his liver. And they basically said, if you know anything about pancreatic cancer, they basically said dead man walking, and they gave him 90 days to live. And like to the point where the oncologists were even like, we can't even treat you. We could whack you with the hardest dose of chemo and radiation, and there's nothing we could do for you. Maybe we'll get you to 5 or 6 months, but your quality of life will be so bad, it's not worth it. And so I say this, and I share this story because my wife and I were just like that. We're not taking that as an answer. We're not going to go down without fighting. And so we looked at alternative treatments. Now, these are treatments that insurance doesn't pay for, that you need to have capital for. And by the grace of God, we were able to accelerate a death benefit. And 3 years later now, almost in November, it'll be 3 years. My father-in-law today is playing golf right now.
Amazing.
And he sees his grandkids 4 days a week. And he lives 4 miles down the road from me. And that's all because of living benefits, right? So if you're able to, like, if you think about, like, a lot of people think about the death benefit and they think about death insurance. No, it's called life insurance because it provides benefits through life. You have the access to the capital. I wrote a book called Cash Flow Hacking. And the whole point of that is like leveraging whole life insurance to invest in real estate, cash flowing real estate. You know, rather than these buy and hold strategies, let's start focusing on building cash flow, utilizing whole life insurance as a foundational asset to do that. Okay, that's one part. If you become critically, chronically, or terminally ill, I don't know how it works in Canada, but in the US, you have the ability to accelerate your death benefit. If you lose 2 of 6 daily functions or become cognitively impaired, you can accelerate your death benefit to pay for long-term care, to pay for assistance, medical treatment, alternative treatments, whatever you want. You get diagnosed with the cancer, like my father-in-law, you can accelerate the death benefit. It was almost $250,000 out of pocket cash. Wow. That had to be paid. Now, that was all able to be paid with tax-free dollars. Because accelerated from the death benefit.
That's a really great story. It's a very touching story too. I mean, and you just reinforces how much you really believe in this product. You're not just out there promoting it. Like, you have a personal story. I mean, you talk about cash flow hacking. I have a personal story too. I mean, I do this all the time. I just recently purchased a condo leveraging my cash flow, my cash value from my policy. I was in Vegas with my wife, and I was just fooling around on realtor.ca on the MLS. I'm also a realtor too, because I have a listing for a client's condo for sale, and I was just curious as why I wasn't getting a lot of showing. So I wanted to see if there's any new listings, and I found in the same building, this guy put up a condo for sale. It was like $130,000 less than what my client was selling it for. Oh, wow. And I'm like, what's going on here? I look at this condo, and it's a piece of shit. Like, it is, it needs, and I'm like, oh, I'm licking my chops. I love this because I used to be a home builder about 10 years ago. And that's all I bought were estate sales because they needed a lot of TLC. Nobody really wanted them. And from Vegas, I called the realtor and I said, hey, what's the deal on this? He says, it was an estate sale. My mother's uncle passed away, left it to her. There's no mortgage on it. She just wants the money. I said, how about if I make you an all cash offer and I'm going to close in 10 days? He said, send me the offer. So I sent him the offer. How was I able to do that? I don't keep $450,000 cash.
Right. Yep.
Right. But it was borrowed against a life insurance policy.
Yep. And then after, you have the flexibility, you can cash out, refi, you can do a lot of different things that you want to do. But access to capital is king, right? Like, and that's where Nelson Nash, in his book, I think my favorite quote that I got from him when he wrote the infinite banking concept, the Become Your Own Banker book, was the more money you have, the more opportunity has a way of tracking you down, right? Like, and so like, it's and that's the thing. Like, we're launching a private equity fund, and we're doing this hotel down in the Dominican Republic and retreat center and doing all these things. And that only happened because we had access to capital, right? Like, you can't get loans to go build in the Dominican Republic or do stuff like that right now. So we had to secure it all with personal stuff. And had it not been for our whole life policies, that would have never been possible.
Well, why is there more millionaires created during a recession? Access to capital.
Yep.
They've got the access to it. They're sitting on cash, or they have access to cash to take advantage of Black Friday sales.
100%. Yes.
Right. On real estate, totally. They have big sales. They have the access to it.
Yep. Totally.
I get a lot of Dave Ramsey fans commenting on my post saying that I'm giving bad advice and that people would be better off buying term and investing the difference.
Mm-hmm.
I'd like to hear your thoughts on that.
First of all, no, I mean, can it work in a vacuum, buying term and investing the difference? Sure. My response to that is you don't solve long-term problems with short-term thinking. And buying term and investing the difference is a short-term problem because and you're not comparing all the needs that a person has in life when you're just comparing those two things. But because if we say, hey, buy term and invest the difference, I could say, okay, John, you should buy term and invest the difference. And then you go, okay, Chris, like what would that look like? And I'd say, well, you buy a 20-year term policy because you got kids, and in 20 years, kids are gonna be out of the house. And in 20 years, you're not gonna need the insurance. You're gonna be self-insured. Okay. First of all, I don't believe in that concept, but second, let's just say, okay, maybe let's just assume, play devil's advocate, say that's the way it worked. Okay. Well, I'm investing the difference and the money's going to grow. Okay. Well, am I even going to invest the difference? I mean, studies have shown people don't actually invest the difference,
True.
first of all.
Yep.
But then what happens after the 20 years? I'm 43 right now, right? I'll just talk about me, right? If somebody's telling me to buy term and invest.
You're 43? Well, I'm going to take this as a compliment because you said we're pretty much the same age. I'm 52. So I'm going to take that as a compliment. I look 43.
That's awesome. So I'm 43. I got a 12-year-old, a 9-year-old, and a 5-year-old, right? And so I'm looking at this. I got another 15 years of my kids being in the house, right? At least, hopefully only 15 years. But that said, let's say I bought a 15-year term and I bought into this buy term and invest the difference. And let's say I invested the difference. And then, 15 years from now, my term expires and I self-insure. What about all the living benefits? What about being able to control my medical directive? What about having a volatility buffer in retirement to be able to make my retirement income more stable, more secure, more less volatile, we'll call it, right? What about the fact that I need to save emergency fund too? I think the biggest mistake that we make is we buy into this bullshit story, quite frankly, about the younger you are, the more risk you can take, right? The reality is the younger you are, the less risk you have to take because we have time and compounding and ability on our side. And so I kind of look at it and say, if you understand that, the problem in the world right now is we have too many speculators and not enough investors.
Correct.
And the difference between that is, for everybody listening, is when you go and invest and you don't have a financial foundation of safe, liquid, accessible capital, there is a backstop. If you go and invest, you're not really investing, you're speculating because you have to ride the wave of the market and you're taking on risks that you shouldn't be taking on. You're not ready to take on yet, because if you're taking that risk and you can't take and ride the waves, well, then you're not ready for it yet. You need to slow down, build your foundation, and then go take risk, then go invest. If you invest before building your financial foundation on safe, guaranteed money, you are a speculator, not an investor. Make no mistake about it.
100%. Everybody says, oh, I'm investing in the stock market. No, you're not. You're speculating in the stock market because unless again, it goes back to your belief and your investor DNA. Yep. What do you know? What do you know? People think, let's just clarify for what your investor DNA is. Your investor DNA is what you know best.
Right.
So if I don't know anything about the stock market, and let's just go back to a mutual fund, because Dave Ramsey says, oh, you should be able to self-insure because you're going to get 10 or 12% on your mutual funds.
Yeah.
Where the fuck are you getting 12% on a mutual fund, Dave? Because I don't know any mutual fund that consistently gives you 10 or 12% every single year after fees. I don't know any. But anyway, unless you're on the inside and you know everything about the board of directors and you know everything about the company and all the moves that the company and the directors are making, you're speculating. And by speculating, you're up for loss. This is you're not investing for certainty. You're investing for hope, and hope is not a plan.
It's true. I mean, and even go outside of mutual funds. I think one of the biggest risks that we have right now is cryptocurrency. Right. Listen, I like crypto. Like I'm all about having some Bitcoin, having some Ethereum, maybe some altcoins, if it's the right thing for you. But I'm not all about going and putting all your money into Bitcoin and speculating as to how it's going to go and having no safe money in your life. Because what happens if and when the wave of Bitcoin happens? And what happens if it's on a downswing and you need access to that capital? If you don't have other places to pull from in times of need, well, then that asset is not an investment. It's a speculative thing that actually can put your life at more risk than the upside. benefit, you know, and I'm always just looking at life through like, what's the upside? What's the downside? And can I live with the downside? And I think too many people just don't look at the second part of that equation.
Absolutely. You know, going back to buying term, investing the difference, first of all, we both know that 99% of term will never pay out.
Right.
But then if you listen to Dave Ramsey, he says, well, you don't need it then because you're going to be self-insured. Well, here's my question for those people. You have a $1.5 or $2 million house. Do you have insurance on it? Yeah. Why do you have insurance on it? In case of fire, right?
Yeah.
If you don't have insurance on your house, can you safely put aside $2 million in case your house burns down? Well, no, I don't have 2 million. So then you need insurance, right? You put insurance on your car for loss. It's always for loss. So this whole self-insured thing, there's no logic behind it whatsoever.
Well, it's beyond that even, I think. It's like you're either insured or you're not insured. You're not self-insured, because the nature of being self-insured, let's say you have a $2 million house, right? Or let's say you have $1 million house, or 500. Let's bring it down. Let's say you got a $500,000 house.
Not in Canada.
Right?
Not for 500 grand.
No? Okay.
No.
No? Okay.
No, about $1.5 million.
All right. So let's say you got $1 million house. Okay.
Yes.
Just you got $1 million house. When you hit retirement, if you follow Dave Ramsey saying, and let's say his idea is like, you just want to self-insure. The equivalent would be saying, all right, I've got this $1 million house. I don't need insurance on it because I'm going to self-insure because I got my money over here. I've got enough to cover it. The problem is there's a lack of efficiency with self-insuring, because now I have an opportunity cost with self-insuring, because now I've got this $1 million over here that I have to earmark in a worst case scenario that has to be able to take care of this problem over here of making sure my house is covered, right? And so there's that opportunity cost creates a lot of efficiencies of what we're able to do with our capital. And that can create a lot of problems. And so I always, my overall mindset is like, one of my first mentors back in the day, you know, said, Chris, if you want to be successful, find people that have the life that you want to live and emulate what they do until you get there. I think it's a pretty simple model, right? And so I look at that and I go, all right. And it's one of the reasons I fell in love with whole life insurance, is because all the wealthy people that I was talking to were utilizing it. And I was like, all right, that makes sense. If they're all doing this, I guarantee you every single one of these people could self-insure if they wanted to. Why do they still then own life insurance? Is because it's not about like having this minimalist scarcity mindset. They have a mindset of abundance and creation, paying it forward, leaving the next generation better off, and making sure that we give as little money to the government as possible and as much money to our family and in our own financial ecosystems as possible, right? And that's what life insurance does. The one thing I'll say is this: there's so many influencers online saying, do what the Rockefellers do. I just had a great conversation with Garrett Gunderson about this the other day. He's like, do what the Rockefellers do. Buy life insurance to create wealth. No, you don't create wealth with life insurance. You create wealth with your investor DNA, intellectual property, investing, building businesses, creating value in the world. That's how you create wealth. Life insurance is the backstop to make sure that you keep your wealth, to make sure that you can enhance the growth of the wealth. It can be an accelerant, but make no mistake about it, the policy itself isn't going to create wealth. That's on you, right? That is going to be there on the backstop. But when you understand that concept and philosophy, now on the back end of that, it's like, all right, with what I've created, how do I be the best steward of that as possible moving forward generationally? And while we're in retirement and all the living benefits that it provides, like the whole buy term and invest the difference concept is a joke. It's laughable.
Well, yeah, because, you know, most people, they're not going to be very disciplined and to invest the difference. There's always going to be something that comes up. Oh, I got to take this trip. I want to go to the Dominican for a week, so I'm not going to put money into my investments this month, and I'm going to delay it. Or I need new rims for my pickup truck, or I need this new purse. No one is disciplined enough to actually follow that rule. And if you listen to Dave, no one is getting 10 to 12% consecutively every single year. And then here's another thing. I saw a video clip of Dave having a conversation with someone, and they told him, well, you could have the safe withdrawal rate of 8%.
Jesus. That's insane.
I said, oh my God. The only reason why this guy is not getting sued is because he's not a licensed financial advisor.
Right.
He's a talk show host masquerading as an advisor.
Well, he did just get sued.
Did he?
He's in a class action lawsuit because he got involved in, he was suggesting people buy this or put money in with this company. And they did, and ended up being, I think, like people got ripped off. And they weren't disclosed to that Dave Ramsey was being compensated for the suggestion.
Oh, okay.
And it was it's $150 million lawsuit.
Oof.
Go, look it up. Look up Dave Ramsey lawsuit right now. It's like a class action thing against him right now.
Oh, that's fantastic.
It's happening right now.
That's great. But the idea of, and even let's just go back to, well, the safe withdrawal rate right now is not even 4%. It's like 3.5% because the studies have been ran that even 4% is not feasible. It's about 3.5%. But let's just talk about that for a second, because I talk about, and we are of the same cloth, and Garrett Gunderson is not to accumulate, but to buy assets that are going to create cash flow. Let's have cash flow. Let's look at focusing on building cash flow, not accumulation.
Totally.
Right?
100%.
And whole life insurance helps do that.
Yeah, I mean, it's the idea is my philosophy is buy your net worth, build your cash flow. And that's what you can do with whole life insurance. You're basically buying your human life value and your potential net worth. You're able to purchase that through life insurance. And that's why I always say whole life insurance is the only financial asset in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not.
It's a guarantee.
Think about that. It's guaranteed.
It's a guarantee. It's not hope.
Think about that. Think about the power in that. And I think the thing I love that we do is not just like the money. We talked about your values and beliefs and your investor DNA and all these different things, but the idea of well, think about it this way. We are all where we are in life because of who we are, right? And whatever. And at the end of the day, where I am right now, where you are right now, where everybody who's listening to this right now is, chances are you're not where you want to be. And I would encourage that you shouldn't be where you want to be. You should be on a path of growth. Even Tony Robbins always says, everybody always goes up to Tony Robbins, I'm going to be where you are. He's like, I hope so. Because by the time you get to where I am, I'm going to be long gone. Yes. I'm going to be way higher. And that mindset of perpetual growth, I think is important. And I think we need to embody that. And so when we look at that, the thing I love about whole life insurance, it's the only strategy I know, this whole concept of buying your net worth and building your cash flow, is that it forces you to implement principles and structure that force you to become who you need to be to live the life that you want to live.
That's really good. That's really good. There's a big debate going on with IUL, Index Universal Life Policies. Dan Andrews is a big proponent.
Doug Andrews.
Oh, Doug Andrews. Sorry, Doug Andrews. Big proponent of IUL. And I know I see a lot of your YouTube videos, and you try to distinguish and you compare the IUL to whole life. Explain to my listeners what that difference is, because we're not so big in Canada on IUL, but we are big. They have universal life policies, not so much on the index universal lives. And I know that you do a lot of comparisons on the two and why people should be really focusing more on the whole life side.
Yeah, well, so IUL and UL, let's just talk about that first. The difference is nothing. I mean, the difference, an IUL is simply a UL product with an options strategy attached to it. That's it. So as far as Canada goes, good for you for not having that, because it's a bunch of smoke and mirrors and it doesn't work the way they say it does. It illustrates really well or whatever. But it doesn't ever perform or live up to expectations or promises, right? And so that's important. The fundamental difference and the reason I like whole life insurance is because when it really comes down to it, it's a function of when you're buying a policy and saving money inside of a life insurance contract, you're effectively saying, hey, life insurance company, you've been doing this for 180 years, 100 plus years. You've weathered every financial storm. I'm going to have you manage my risk for me, get the best return possible with the least amount of risk possible. And I'm going to trust that you're going to do that for me and with me moving forward. And so I'm going to hand you my money and I'm going to become effectively a shareholder with a participating mutual company. When you put your money into a whole life policy, you are a shareholder, basically a business partner with the company. You succeed when they succeed, right?
Yep.
So when you put your money into a whole life policy, you are a partner with a company. When you put your money into an IUL or a UL, you're a profit center for the company.
And let's really distinguish between a mutually owned company and a stock company. You're talking mutually owned.
Mutually owned whole life insurance companies.
Yes, not a stock insurance company.
But let's go deeper, because there are mutually held companies that offer UL products as well. At least in the United States, there are.
Okay.
Right? And so a lot of people have now been pitching IUL and UL products saying, it's a mutually held company. Yeah, that's great. It's a mutually held company, but you're not buying the product that participates in the mutuality of that. You're buying a product that is the profit center. So I got news for you. If you're buying a UL with a mutual company, it doesn't matter. You're still going to be a profit center that they're going to use that to meet the guarantees that they have with the participating mutually held policy owners.
Right.
And so it's just, do you want to be a business partner or do you want to be a profit center? Business partner, participating in the success of the company as a whole life policy. Profit center, that means you're at risk. And, you know,
and you can still you can have losses in a UL policy, correct?
Of course, all the time. Yeah, look at the guaranteed columns on any UL, and it'll make you run the other way as fast as you can.
Plus, there's more fees, no, inside a UL policy than a whole life.
Oh yeah, totally. I mean, like so the whole concept of universal life is it's a blend between cash value and annual renewable term insurance. And so it looks really good for the first, 5 to 10 to 20 years, depending on your age when you buy it. But by the time you hit 65 and your annual renewable term goes up and, you have a couple $100,000 of insurance, as you get older, those costs go through the roof, right? And the challenge is most people, when you're buying it, at least in the US for UL-based products, it's all being done for retirement income. So the problem is it's when you need it most is when you're going to be let down. And then if it happens and you have a policy lapse before you're 75, which most people are going to, unfortunately, and this is going to be a day of reckoning. If you have a policy lapse before you're 75, not only does your policy lapse, but you're going to get hit with a big old tax bill in the United States. I don't know how it works in Canada again, but there's overloan protection riders on these policies to make sure that doesn't happen. But if it happens to you before, those riders don't kick in until you're 75 years old. So if the policy lapses before you're 75 and you have loans out, not only do you have to pay a capital gain tax on the money and the income that you took out of it, but all of the loans, the outstanding loans that you owe on it, it's just compounding behind the scenes. You're going to owe taxes on all of that as well.
Wow. Why should everybody have whole life insurance as part of their financial plan?
Because it's just smart. It's not sexy. Because
it's boring.
Success isn't sexy, y'all. Like, yes. I mean, like I think about my father-in-law was a national GE General Electric Engineer of the Year 3 times. He met 3 presidents. Have you ever heard of the Apache helicopter?
Yeah.
My grandfather developed the weapon system for the Apache helicopter.
Very cool.
And so, he got to meet all these amazing presidents. And so, like, my grandfather, had his flaws, whatever. But like from a success perspective, he is like my model of success, growing up. And I just remember growing up and watching him like make all this money and buy all this land and do all these things. And I'm growing up like watching this guy and everybody's like idolizing my grandfather. And he's driving like an old Crown Victoria. You know what I mean? Like this old beater car that's like in the 80s and it's rusting out. And I'm like, something doesn't make sense. Everybody says my grandfather's like this rock star, super successful engineer, real estate investor, all this stuff. And he's driving a car that's got holes in the floorboards, like what is going on? And it's like, success isn't sexy, like that's like in a lot of situations. Then you get all these like, wannabe Instagrammers that, are renting Ferraris and Lamborghinis just to look cool. It's like, get your priorities in line. You can look cool, or you could be successful. And I guess eventually you can make enough to be both, if that's what your priorities are. But what I find is that the more success you actually build, the less interested in looking cool you are. You want to just kind of blend in and do your own thing, and so, like, I don't know, why should everybody have whole life? Is because there's no other predictable way. There's no other asset that's going to make sure that you're going to have a set of rules and filters that you can run every decision that you make through your life with your finances to make decisions on what is a good investment. It's going to help you grow to be first and foremost. It's going to help you save money, save with the intent of investing. So when you know how to invest, or when you find the right investments, you're going to be capitalized to do it with less risk, not be a speculator, but be a true investor, right? And so when you do that, that's fantastic, right? Because now you're ahead of the game, but you're also going to have the life insurance there to backstop you, to make sure that your plans are going to be actualized. The only variable is you, right? Yeah. So I guess the only reason not to use life insurance is because you don't want to take whole life insurance, is because you don't want to take radical self-accountability for the results in your life. That would be the reason you don't want it.
That's a good point. So you just launched a fund called the Cash Flow Hacking Fund. Yeah. And you're investing into real estate. What made you choose real estate as the investment, and why?
I mean, so many reasons. Cash flow, first of all. The fact that you can create cash flow that beats returns of most investments. The fact that you can have appreciation that is a multiplier of wealth creation. The fact that the tax benefits are actual and real. They're not deferrals. They're not kicking the can down the road. Mm-hmm. It's actual real deductions that are real money in your pocket that you can create leverage with. And the fact that, when we talk about it, it all goes back to the cash flow. It all goes back to, I don't want to put my money into something that I have no control over, and that's not going to provide cash flow or any real benefit for 30 to 40 years. And I got to just cross my fingers and pray and hope that it all works out. Like, I'm investing in something that I have a direct influence over the control of the success of it. We're launching this fund. We're investing in a hotel retreat center down in the Dominican, investing in the path of progress. The cash flow is going to be over 20% right out of the gate. Like after the first year is over, we're going to hit 20% once we, the first year we're going to invest into it and like fix the place up, do our thing. And then, so that's cool. The appreciation, because the government is investing in this area, the property and the value of the land is going to appreciate. So when we exit the deal, the multiple is going to be through the roof compared to anything else. You can't do that in a stock for the most part. You could do that when you build companies. You don't do that by investing in mutual funds, right? There's a difference. And that's why everybody compares to Warren Buffett. Warren Buffett builds companies. Warren Buffett does what we do in real estate, but he does it with companies, right? That's the difference. So nobody's Warren Buffett. Everybody always likes to compare themselves to Warren Buffett, but nobody's Warren Buffett. And so there's that. And then, and at the same time, it's like, I'm moving my family there. We're all in on this, right? Like, because I know I'm taking accountability and responsibility. I'm investing in something that I have a direct influence in the success of. Whereas if I put money in a mutual fund, it's out of my hands. I shift my responsibility to somebody else, and that drives me crazy.
Yeah, and you're passing that responsibility on to someone that you have no clue of who these owners or the directors of these companies are, who the CEOs have. No clue. Right. No clue.
And that's the challenge. Like, you don't know all the different layers of it. I was talking to Garrett the other day, Garrett Gunderson, and he said something, and I never heard him say it before. And I guess I've thought about it like this, but I never phrased it so succinctly. He's like, Wall Street is a value extraction machine. They created Wall Street and the whole financial system in that capacity to create more leverage, more control, more wealth creation for them. 100%. And not Main Street. It's like Vegas, in the sense that Vegas is going to let you win every now and then, but they're not going to let you win enough to build your own casino. They're going to build their empire off your back. They're just going to give you enough back every now and then to make you feel good.
There's a very good reason why when you go to Vegas, There's so many hotels and they're so luxurious and beautiful. It's because the house always wins.
Always.
And Wall Street is the house. I actually just this morning, I watched one of your shorts, your YouTube shorts. You said that if the advice that was given by the people of Wall Street, if it really was to develop wealth, then 90% or 95% of the people would all be wealthy. Yep. But that's the opposite. 90 to 95% of people, 95% of people lose in Wall Street. True. And this is why I wrote my book. You know, you've got your book that's called Cash Flow Hacking, and I've got my book coming out hopefully in March. It's called Wealth Without Wall Street, and I talk about real estate. Why I like real estate for the appreciation. It's an asset I can touch. And over the long term, real estate has never lost over the long term. It cash flows. There's great tax provisions with it. And I talk about life insurance because of the tax provisions and how it's so safe. And if you go back into 1929 during the Great Depression, over 9,000 banks failed. Not one life insurance company failed. It was the life insurance companies that helped bail out some of these banks during the Great Depression.
Love it.
Right?
It's amazing. It's amazing. Yeah. I mean, there's no...
If the advice was so good.
Oh, yeah. No, there's no doubt. Listen, do you know who Harry Dent is?
No, I don't.
He wrote a book called The Demographic Cliff. He's an economist. He's a big investor guy. And I had him on my channel, I don't know, like a year ago. And it was really cool. Like for me, it was like one of those like Michael Jordan, like he's like this super just really amazing author who I really respect his opinions on a lot of these things. And so the fact I met him at a conference and he agreed to come on the channel, and he's got hundreds and hundreds of thousands of followers, like in the fun. He's like a Peter Schiff kind of guy. And so I got him on the channel and he didn't even know really what I did. He just agreed. We talked for a couple minutes at a VIP thing at this event. And he's like, I'll come on your channel. That's cool. And so I got him on and I was like, Harry, what do you think about life insurance companies right now? Because he's all about like bonds and all that stuff right now. And I'm like, what do you think about life insurance companies? He's like, life insurance companies, they're the best companies in the world to keep your money with right now. Right now is like the best time ever to put your money with a life insurance company. You know, and he went down and he went through the history. I was shocked how well this guy knew the life insurance business because he never talks about it. And he's like, back in 1929, all these companies failed. All these banks failed. Life insurance companies were the only ones to thrive. 2008, same deal. COVID, like all these things. Right now is the best time to put our money in a life insurance contract than ever before because we need the stability. We need the guarantees. And I know a lot of people are worried about like what's going on with in the United States, the devaluation of the US dollar, possibly losing the world's reserve currency, doing all this stuff. Well, I got news for you. Like if you keep your money in a bank, you have that reserve, you know, the currency risk. You put your money with a life insurance company, they manage that risk. In the United States, at least, the US has been through 3 versions of the US dollar since 1842. Life insurance companies have never missed a dividend. They manage the risk. And when it makes sense, if in fact Bitcoin or some digital currency winds up being a real viable possibility, I promise you the life insurance company is going to manage that transition and manage that risk better than you're going to.
If you want a real testament to the truth of that, just go to any city and find the biggest, most luxurious buildings in any city. Who are they owned by? Banks.
Banks.
Well, banks and life insurance companies.
Yeah. But the reason the life insurance companies are is because they've been doing it for 180 years and it's compounding in time. Banks are like, yeah, we're 10 years old. We're just going to.
So banks are so profitable. So if you're going to take advice from listen, banks give advice that benefit them, not you. But if you were to do what the banks do, what do the banks do? Where do they put their tier 1 money? Boley. Bank-owned life insurance. I mean, just take a look in the United States. There's over $200 billion of whole life insurance owned by banks. They don't buy mutual funds.
Did you see I did this reaction video to Dave Ramsey, going back to Dave Ramsey on this, right? So Dave Ramsey
This is a beat
got
up
on
Dave
this
Ramsey show.
heated debate with Infinite Banker was the title of his video. And it literally came across my feed because I subscribe to Dave Ramsey on YouTube because I'm a masochist apparently. But
is this the one where he says banks don't buy life insurance?
Banks, he's like, and the guy's like, and Dave's like trying to talk to this guy, and he's like, why would you ever put your money in a whole life policy? And the guy's like, well, banks do it. And Dave Ramsey literally goes, banks aren't stupid enough to put their money in a dog pile crap policy, like product, like whole life insurance. Banks aren't stupid enough. That's what Dave Ramsey said. And so I go, that's like, I know they do, right? Like,
yeah.
And so I was like, I'm going to react to this video. And I found a website that tracks life insurance assets owned by banks in the United States. There were over 3,000 banks in the United States that have over $10 million of life insurance as an asset on the tier 1 level of their balance sheet.
Bank of America's got over 20 billion of it. JP Morgan's, I think, is at like 17 or 18 billion. But if you just take a look at not even all the banks, but just, I think it was the top couple hundred of the top US banks, it's over 200 billion with a B. So Dave, you're wrong. Mud in your face, buddy.
I know, right? He doesn't care.
I know.
He's so big.
He's a talk show host. He's just, he's an entertainer.
Yep.
You talk about cash flow hacking. You wrote your book. What is cash flow hacking?
So the idea of cash flow hacking is simple. It's having a process to create wealth, saving money with the intent of investing. But when you do invest and you deploy that capital, you invest in cash flow producing assets. I personally like real estate, and that the book focuses heavily on real estate. But it's basically the concept and the strategy to walk you through, like, all right, if you can either hop on the hamster wheel and try to do it the way that we're taught, to go to school, get a job, invest in a 401k or RISP or whatever you guys have up there, and and hope that by the time you're 65, it all works out for you. Or you can, grab life by the horns and say, all right, I'm gonna do what I do to create cash, but I'm gonna save money. I'm gonna look for cash flow producing assets. I'm going to invest in those cash flow producing assets. I'm going to use the cash flow to recapitalize my own bank, as we were talking about, my own account. Yep. And then as I recapitalize and as I keep contributing, I'm going to then compound that back up with the cash flow from the first asset. I'm going to buy the next one, and then everything starts to compound. This is how we compound wealth. And rather than wait 35 to 40 years, you can have literally financial freedom and be completely retired in 10 to 15 years max.
Yeah,
regardless of where you're starting. And so that's the idea, is like, let's take control of the results in our life, and let's become who we need to be to live the life that we say we want to live. And I know most people, because it comes back to what I said before, most people are not doing that because they don't believe in their subconscious mind that it's even possible. And the reason they don't believe it's possible is because what you're doing now is not in alignment with your values and beliefs. So you got this internal conflict going on that you don't even know how to articulate.
Right.
So what this does is it aligns your money with your values and beliefs. It puts you at the helm of the ship of your own life to create your own results, your own success, your own time frame. And really, that's what it comes down to.
Amazing. I love it. I love it. Chris, this has been great. We're all out of time, but I feel that you and we can just go on about this for hours and beat up on Dave for another more time.
And maybe we should sometime,
We should. No, I love it. But this is fantastic. How can people find you? Because I know you're really big on YouTube, and especially in the US.
Yeah. So YouTube is at Life180, LIFE 180. It's an acronym. It's all capitalized. LIFE is an acronym for living intentionally for excellence. And 180 is all about turning the results in your life around, especially with your money. And so at Life180 on YouTube, and it's at Real Chris Kirkpatrick on TikTok and Instagram.
Fantastic. Well, this has been great, guys. If you're listening and you want to actually watch the podcast, please go over to our YouTube channel. It's John Durbano. Check out the episode with Chris and I. It's been wonderful. If you want to follow me on social media, it's John Durbano at TikTok and also on Instagram. Guys, this has been wonderful. Thank you for joining us. Thank you for listening. Please subscribe. Take care of yourself and take care of your wealth.